My name is Jim Weisel, Professor of Accountancy at Georgia Gwinnett College. In this video, we're going to introduce how to go about determining whether a lease is an operating lease or a capital lease. So when we are looking at or evaluating a lease agreement, what we need to do is to determine whether the lease is accounted for as an operating lease or a capital lease. And the perspective, at least right now with US GAAP, is that all leases are assumed to be operating leases unless they meet one of four specific criteria. So the first criteria that we look at is, does title transfer? So we have an owner of an asset, that's the lessor, and we have someone or an entity who is going to be making use of the asset, that's the lessee. The owner holds title to the asset. If title is going to transfer at any point during the lease, then we would answer yes to this question. If title does not transfer, if there's no mention of title transferring in the lease agreement, for example, then we cannot infer that title is going to transfer. Or if most leases will explicitly state whether title is transferring or not. So we have to evaluate a lease agreement, look for any indication of whether or not title is going to transfer. If we answer no to this question, title does not transfer, in other words, the lease agreement specifically says that title is not going to transfer, which is fairly common, or that the lease agreement does not make any mention of title transferring, then we can answer no to this question and move on to the next criteria, which is there a bargain purchase option, sometimes labeled BPO, bargain purchase option. What a bargain purchase option is all about is at the end of the lease term, are we giving the lessee, or is the lessee able to buy the asset for significantly less than fair market value? Now, the Financial Accounting Standards Board has no hard cutoff for what is significantly less than fair market value. But just as an example, an extreme example, let's say that we're leasing a delivery truck, and we're going to lease this delivery truck for a couple of years, and the lease agreement says at the end of the lease term, the lessee can buy this delivery truck for $1. Well, that was certainly be more than the fair market value, or is going to be most likely more than the fair market value of the asset, and so we would answer yes to that question. There is a bargain purchase option. Sometimes lease agreements will have language in there that the lessee can buy the asset for, say, 95% of fair market value, or at their option, they can buy it at fair market value. We have to use our best professional judgment to determine whether that the ability to buy the asset at the end of the lease represents a bargain purchase option. Is it significantly below the fair market value? As you get to maybe 85, 80%, 75%, and so on of fair market value, that's probably where we're approaching having to conclude that we have a bargain purchase option. But if the lease says we'll determine the fair market value of the asset at the end of the lease, and you can buy it for that if you want, then that would not be a bargain purchase option. And so in that case, we would again answer no to that question. The third criteria is the lease term greater than or equal to 75% of the expected useful life? Now, a lot of assets, what we do is we'll use the tax tables, even though this is not a tax situation. A lot of companies will use the tax tables. There is a publication prepared by the IRS that identifies expected useful life of a wide variety of assets, everything from oil and gas refining equipment to computers to desks to buildings and so on and so forth. And so we have to evaluate or examine the term of the lease, for how long are we going to be leasing this asset, and we compare that to the estimated or expected useful life. And if the lease term is greater than or more than 75% of the expected useful life, then we would answer yes to this question. If it's less than that 75%, then we would answer no. So for example, let's say we're going to lease an asset that has an expected useful life of 10 years. If the lease term is, say, 7 years or 6 years, then that would certainly be less than 75%. If the lease term is 8 out of the 10 years expected useful life, then that would be 80% and would meet this criteria. Now, where a lot of companies will try to sort of manipulate things is, say, for example, again, we've got a 10-year useful life on an asset. That's 120 months, right? So 12 months times 10 years is 120 months. And so what we would do, perhaps, is write a lease agreement whereby we are leasing this asset for 89 months. Well, 89 out of 120 is only 74% of the expected useful life. And so we would answer no to that question. So you can see where there is the potential for some manipulation, particularly on the lease term, because as we are drafting the lease contract, we have some ability to alter the terms or to negotiate the terms of the contract and so on. Let's presume in the lease contract that we're examining here that we answer no, that we're going to lease the asset for 5 years and the expected useful life is 10. That would only be 50%, so we answer no to that question. The fourth criteria, and arguably the most complex criteria to evaluate, is the present value of the minimum lease payments greater than or equal to 90% of the fair market value. So what we have to do is we have to identify the lease payments that are going to be due on this lease agreement, and then we have to discount those payments to present value terms. We've talked about present value in a number of circumstances, most likely with bonds, with installment notes, and so on, and long-term notes payable. So we're already familiar, hopefully, with the concept of present value, the lease payments. And what we do is we compare the present value of the lease payments to the fair market value of the asset. If the present value of the lease payments is less than 90% of the fair market value, then we would answer no to this question as well. Now, once again, there's a potential for some manipulation here of the terms of the contract. If we are negotiating a lease, and we can negotiate what the lease payments are, the fair market value we'll probably be able to establish with a reasonable degree of certainty, but we can negotiate or modify the lease payments such that we can achieve an outcome that we want, which would very often for the lessee be avoiding having to account for this as a capital lease, trying to keep it as an operating lease. So now we have the four criteria, a little bit of an understanding of what those four criteria are and how to go about evaluating them. Here's what happens. We go through this sequence. Does title transfer? No. Does bargain purchase option included in the lease contract? No. Is the lease term for 75% of the expected useful life? No. If the present value of the minimum lease payments is less than 90% of the fair market value, then we answer no to that question as well. And we have an operating lease. Operating leases, from an accounting standpoint, are very, very simple. Operating leases, we simply record the lease payments as current operating expenses. So if we have an operating lease, we've answered no to all four of these questions, then we very simply credit cash and debit lease expense or rental expense whenever it is that we make a lease payment. And that's it. There's no asset to record on the balance sheet. There's no liability to record on the balance sheet. There's no interest cost associated with an operating lease. This is basically just a short-term rental, or treated as a short-term rental, and whenever we make the lease payments, we debit the lease expense just like we would when we make payroll payments. we credit cash and debit payroll expense or wages and salaries expense. If we pay utilities, we debit a utilities expense account. Operating leases are going to be treated the exact same way. Where things get interesting and significantly more complicated is if we answer yes to any one of these questions. And it doesn't matter which one. Does not matter whether it's title transfer, bargain purchase option, lease term being more than 75% of the expected life, or present value, the lease payments being greater than or equal to 90% of the fair market value. If we answer yes to any one of those questions, then we have what is classified as a capital lease. The idea here is that a capital lease is going to be accounted for basically in the same way as if we had purchased an asset. In other words, Financial Accounting Standards Board is concerned about something called substance over form. So if title transfers somewhere along the lease contract, well, that's what happens when we buy an asset. If there's a bargain purchase option, in other words, we make some rental payments but then are able to buy the asset for significantly below fair market value, well, then that's kind of something that would potentially happen when we purchase an asset. If we're going to use up 75% or more of the expected life, then we as the lessee are making use of a substantial portion of the benefits of the asset, just like as if we had purchased it. And if the present value of the lease payments is 90% or more of the fair market value, well, again, that's exactly what would happen if we were purchasing it. We would have to pay for most, a vast majority of the fair market value of the asset. So the idea here is if we, as a lessee, get the benefits similar to purchasing an asset, then it doesn't matter what we call or label the contract at the top. We can call it a lease agreement, we can call it a rental agreement, but if the substance of the agreement is such that we have the same benefits and risks of ownership or similar benefits and risks of ownership, then it's going to be treated as if we had made a purchase. And that's what a capital lease is. What we mean by a capital lease is capitalizing the asset. In other words, we will record an asset, leased assets, on the asset side of the balance sheet, and we will record a lease obligation on the liability side of the balance sheet. So the asset and lease liability are recorded at the present value of the minimum lease payments. Technically, it's the smaller of the present value of the minimum lease payments or the fair market value of the asset, but generally speaking, the present value of the minimum lease payments are going to be either equal to fair market value or less than fair market value. So it doesn't happen very often that the fair market value of the asset is less than the present value of the lease payments. It's possible, but pretty rare. So for the most part, we'll record an asset and a lease liability at the present value of the lease payments. And then the lease payment itself, when we make a cash payment, that needs to be separated into principal and interest expense using the effective interest method. What happens with the lease payment is virtually identical to what happens with an installment note payable. The accounting, the financial statement impact of a lease liability is virtually identical to what we discussed related to installment notes payable. Every time we make a cash payment for a lease under a capital lease, part of that cash payment goes to principal, reducing the lease liability, and part of it goes to interest expense. The other thing that happens is because we have an asset on the asset side of the balance sheet, leased assets of some sort, then the asset needs to be depreciated over the term of the lease. Now, if you think about this, this is very similar, virtually the same as what would happen as if we borrowed money to buy an asset. If we borrow money to buy an asset, what's going to happen? Well, we would debit an asset and then depreciate that asset over its useful life. And we would have a liability of some sort, a note payable recorded on the liability side of the balance sheet, and every time we make cash payments we would be reducing principal as well as recognizing interest expense. And that's exactly what happens with a capital lease. So this idea of determining whether a lease is an operating lease or a capital lease is critical to determining how we are going to account for that transaction. So again, just to summarize, if we answer no to all 4 of the criteria, then we have an operating lease, and we just simply debit lease expense or rental expense and credit cash every time we make a payment. If we answer yes to any one of the questions, it doesn't matter which one. If we answer yes to any one of the 4 questions, then we have a capital lease, and the asset needs to be recorded on the balance sheet as well as the lease liability.